In trading, losses are commonplace. Almost every trader will experience one or more significant drawdowns in their career. Even more terrifying than accounted depletion is the psychological damage. Often, a mental breakdown is more painful than losing money. A trader's maturity is judged by how they handle and reflect on losses. In this video, we'll discuss how to avoid unnecessary losses. Rule 1. Distinguish between mistakes and costs. First, it's important to understand that not all losses are mistakes. As the old saying goes, plan you trade your plan. Trading without a plan, even if you make a lot of money, is wrong. Because random luck cannot be replicated. Money earned through luck will eventually be lost through lack of skill. Therefore, after a loss, ask yourself, was this money lost due to reckless trading, or was it lost within planned parameters? Losses that cause significant psychological damage are usually due to lack of planning or a failure to execute the plan. My experience is every trade must have a detailed plan, including expectations and limits. If the market meets expectations, I hold position until the profit target is reached. If the market hits the limit, I stop loss and exit. This is not a mistake, it's a cost of trial and error, part of the plan. But if there's no plan, no limit, or a plan that isn't executed, that kind of loss is a huge mistake. Because this kind of mistake is random, uncontrollable, and the root cause of most people's account blowouts. My first suggestion: always have a plan, and you must act according to the plan. Only then can losses become date for optimization, not just a pure waste. Rule 2. Logical consistency, not mechanical stop losses. Next, let's talk about what constitutes a reasonable stop loss. I'm a trend trader. My principle is enter when the trend forms, exit when the trend ends. The enter and exit logic must be consistent. We cannot control how much profit the market will give. The only thing we can control is how much we are willing to lose. For example, a certain asset experience a sharp decline, then rebounds and forms a small constellation pattern. The moving averages are starting to ally in an uptrend, preparing a breakthrough the resistance level. At this point, if you decline to buy on a breakout, where is your bottom line? The bottom line should be the price falls back inside the constellation range, breaking below the starting points of the rally. Why? Because once it breaks below this point, it means the bullish offensive has failed. The moving average may turn bearish, and your entry logic is not longer valid. So you must exit the trade. This reasonable self-protection. Some people like to use a mechanical percentage like 0% loss for stopping loss, which is actually very unreasonable. Why 2%? Another 2.5%. There's no such a magic number in this market. If a 2% fluctuation is just the normal breathing of the market and it doesn't break the trend, wouldn't you be unfair shift out of the trade? My second suggestion: the stop loss for each trade must be based on the technical logic, not a percentage of the amount. Enter based on the certain logic and exit based on the same logic. That calls logical consistency. Rule number 3: offensive determined by defensive money management. Once we have determined the logical stop loss price, we can solve the most troublesome position sizing problem. Here is a trick: determine your offensive stance based on your defensive position. The algorithm is simple. Calculate the unit loss, enter price, stop loss price, set the maximum acceptable loss amount. How much money can you afford to lose on this trade without feeling any pain. Here's a note. This is an amount, not a percentage. Suppose the entire price is $2.66 and the stop loss price is $2.57. The unit loss is $0.209. I can only accept a maximum loss of $1,000 on this trade. Any more and I won't be able to stop. Then divided 1,000 by 0.09 and the result is 11,111 shares. This is your maximum position size. Many netizens ask how to do money management. This is the best money management. The essence of money management is actually emotional management. Once the loss exceeded your psychological tolerance, emotions will lower your intelligence. And even the best system won't save you. For ordinary investors, managing your emotions is equivalent to managing your money. My third suggestion: for each trade, only risk amount that you wouldn't mind losing completely. This allows you to focus on the trading logic itself in the stress-free state rather than sharing at your account balance and worrying about the gains and the losses. As your trading skills improves, your psychological tolerance will increase and your position size will naturally grow. This is a gradual process. Some money simply doesn't belong to you until you have the ability to manage it. By consistently following these 3 points, you can develop rational trading habits and completely eliminate those random and meaningless losses. If you found today's content insightful, please subscribe and share. See you next time. Peace out.